Okay, I think that was enough updates. So, that was enough with the countdown, I mean. So, I've gotten a number of listener emails and sent in asking about updates on the uranium market. And rather than writing research reports on, I'll just do this for you guys for free right now. Show you guys the quality of the research that I can do. If you're not familiar with the quality of my research by now, if you're new to the channel, if you're not part of my 100 plus Patreon account contributors, almost 150, we're going to talk about the uranium market. So the uranium market has been in a bear market since 2011, immediately since Fukushima. Within hours of the announcements of Fukushima, as soon as the markets opened, the uranium stocks just completely and totally collapsed. I remember this because I was up fourfold on my speculative positions in Denison, which is backed by the billionaire Lundin family, and I gave up all my gains very, very quickly. This is how dangerous the uranium market is, because there's always the potential for another Fukushima, unfortunately. I think there were articles on Zero Hedge about 4 or 5 months ago when California had more earthquakes about how some of the nuclear power plants in California close to the coast in Northern California had some cracks. So anyways, the uranium market has been in a bear market. The top uranium company is called Cameco. They're on the New York Stock Exchange, CCJ, Chris, Jason. They have a market cap right now of $3.6 billion. They do not have an earnings per share. However, they're remaining cash flow positive. I'll talk about their balance sheet and some of the other things about them in a little bit. And they have a 3.26% dividend yield. So not only did they used to mine uranium, but it's not profitable to mine uranium. So they've shut down, I think, for over a year now. First, they drastically cut back their uranium production, and then they just started buying uranium on the open market because there was so much oversupply that it was just easier for them to be a hedge fund or a middleman and just buy the uranium on the spot market and then resell it to fulfill their contracts to utility companies. Tokyo Electric Power, or TEPCO, actually illegally violated their contract. They started not buying from Cameco the uranium, and they started dumping. All the Japanese nuclear power companies did. They shut down all the reactors post-Fukushima. And that created, not only did you have the problems with Fukushima, and by the way, things are still not fixed with Fukushima. It's still a mess. I just saw an article in the last couple of weeks about they're dumping more radioactive water from the fuel rods back into the ocean. And the Japanese people are pissed off about it. They should have never done that in the first place. But anyway, the supply of uranium has been oversupplied, a lot of it, for a very, very long time. The Japanese electric power companies, there was a total shutdown of construction for a lot of Chinese nuclear power plants for years. China was supposed to have already opened many, many dozens. I believe the initial estimates before Fukushima was China was supposed to have opened, I think, over 60 nuclear power plants by now, and all of those plans were pushed back for years. So that severely hurt the uranium market, uranium miners, and that put uranium into one of the worst bear markets in the last 8 years that anyone has seen. The bear market is so bad that shares of Cameco, I think they were around $40 per share before Fukushima. Right around Fukushima, they were around $40 per share. They had good earnings because they had locked in uranium supply in a long-term contract, and then TEPCO violated those contracts, the supply contracts, and Cameco sued them, and I think recently there was a $40 million settlement that court awarded Cameco, even though they weren't counting on it. And those shares have crashed from $40. They got as low as, I think, $8 per share. Now, Cameco is still cash flow positive, and I have up their SEC filings, their most recent ones, their 6Ks. They're a Canadian company. So Cameco, if you're not familiar with them, they own two of the highest grade, lowest cost, longest life uranium mines in McArthur River, which they shut down, I believe, last year because it just wasn't economic to mine it, to give away the uranium at cost or at a loss. And it was just cheaper for them to be a hedge fund and go buy the excess uranium that was being dumped onto the spot market. And then also Cigar Lake, which many years ago had flooding, but it seems that they've got that fixed. That's another long-term growth prospect for them. So Cameco, I was looking at their financials. Cameco has no red flags in terms of a really bad debt to equity ratio or anything like that. Let me see if I could pull up their financials here. See if I have the right. Okay, I have the uranium price. I'll talk about that in a little bit. Okay, I think I have it. Let's see here. Okay, here we go. So Cameco has, if you're going to look at the company in a bear market, you have to look at risk and reward. Is the risk that you're taking with this company, is it worth the reward? Is it worth the upside? Can the company survive the bear market longer? Cameco has, it according to this, from June 30th, their last filings, they have $662 million in cash and cash equivalents. That's Canadian dollars. They have a lot of total assets. In terms of debt, they have around $1 billion in long-term debt in Canadian dollars. It's $996 million. So they almost have enough cash to cover all that. They could sell more shares if they had to, because they still have a $3.6 billion market cap. The long-term debt, they do have cash flow positive though, guys. So the cash flow is coming in with cash flow positive to help reduce that debt. So it's not like they have no cash. And the other thing is, when you're looking at if a company can, a mining company can survive a bear market, you're looking for things like, is the debt to equity ratio, is it way out of whack? Is there 2, 3, 4, 5 times as much debt as there is equity? That's a big red flag. Is there a lot more long-term debt than there is cash on the balance sheet? Is the company not cash flow positive? Are they generating any cash at all? This is why I think a lot of the smaller uranium miners, especially the ones that are not backed by either the billionaire Lundin family, which is a resource family like Denison, or some of the other uranium miners, may not survive the uranium bear market if it continues. So either they have to dilute their balance sheet, or to me at least, they pose way too much risk. Yes, there's reward, but when you look at risk and reward, when you weigh them, risk versus reward, the risks for some of these other uranium miners with their balance sheet and their inability to generate any cash at all, which means that if they do have cash on the balance sheet, they're burning through it. It just doesn't look like worth the risk reward to me. Now, if you're speculating, if you want to have a higher risk tolerance, if you're speculating in those things, okay, but that's not investing then. And the odds of, it's not a safe investment for sure. Cameco is not exactly safe either, but they are on a relative basis, they are a lot safer than a lot of these other uranium miners. I could see Cameco, if the uranium bear market, and there's evidence that the fundamentals are improving. I believe the inventory levels now, which there was an enormous amount of uranium that hit the market because the Japanese nuclear power plants dumped it all back onto the market. And then I think nuclear power plants in Germany and other parts of Europe started shutting down after Fukushima, and they canceled construction plans. That overhang, a lot of the supply overhang of inventory is gone. I think there's only about 3 to 5 years worth of estimates of inventory left. So that is starting to look good. There is still too much inventory, but it's starting to look good. And we'll see if that trend changes. But on the supply-demand fundamentals, the part that's improving finally, and this is on Cameco's website and other places have this research, is 9 new reactors began commercial operation. 9 new nuclear power reactors began commercial operation in 2018 and early 2019. And according to this research, Cameco's estimate, 53 reactors are under construction with many more planned. Demand is growing, and this is going to start increasing demand again for uranium. And the growth is largely occurring in Asia and the Middle East, and it is being partially offset by early reactor retirements, plans for reduced reliance on nuclear, or phase-out policies in some regions. And the largest currently under construction, the most plants, is China with 11, other parts of Asia with 10, Africa and the Middle East with 7, India with 7, Russia with 7, and the Americas, Eastern Europe, and Europe do not have that many. They only have 4, 4, and 3. So 11 total there. China was supposed to have many, many dozens. They were supposed to have over 60 additional nuclear power plants online, but plans got changed a lot with Fukushima. China has 45 reactors in operation, 11 under construction, with a target of 120 gigawatts by 2030. More of the research, there's a ton of other research here on the Cameco website doing this, and the uranium spot price is still very low. It's $25.30 a pound, and it got as high as, I think, let me see here. It's been hovering below 30 for a while. It got as low as $20 on the spot price. The long-term uranium price, which is what the utilities, the nuclear power plant utilities contract at, the utilities contract at a long-term price. The long-term price was 30, but the spot price was 20. So there was the ability to arbitrage there. So there was the ability for a hedge fund or a middleman or even Cameco, if they wanted to stop producing uranium, go in and buy it in the spot market. This is here September 2017. The spot price got as low as $20.33 a pound. So Cameco back then could have went into the spot market at $20.33 and then resold it to utilities if they wanted. And so they've been arbitraging this. So the risk reward to me for Cameco, this is not financial advice, just my opinion. The risk reward to me for Cameco, it's at around $9.12 per share now. It got as low as 8, I think last month, 8 something. It has a 3.26% dividend yield. They are cash flow positive. They do have quite a bit of debt on their balance sheet because they do own some, I think, nuclear power plants too, besides just mining. So the risk reward to me for Cameco looks pretty good, just in my opinion. However, if there's two big risk factors to me, in my opinion, when I'm looking at the uranium market and nuclear power. There's always, and I talked about this at the very beginning of this show, there's always the possibility of another Fukushima. There is a lot of older nuclear power plants out there that should not be running anymore. In the United States, Japan, the UK, European Union, there are a lot of nuclear power plants that are way past, that were only supposed to run for 30 or 40 years and are still running. So yes, they're relatively safe, but they're running way past what they were supposed to be designed to. And this is because the globe, after World War II, they went on a nuclear power binge, especially in the 60s and 70s when oil prices were high, and they started cranking out these nuclear power plants, and they didn't really think about 40 or 50 years from now about extending the plant life or upgrading the plants. They put a bunch of concrete in blocking the radiation, but they did not do a bunch of other safety features. There was a lot of corners cut, and that's why you had Fukushima. I interviewed people, technology experts and engineers fairly shortly after Fukushima, that were saying that as soon as Fukushima was built, I believe there was engineers from Westinghouse and others, American ones, that were warning TEPCO. As soon as the Fukushima plant was built, that corners were cut. And I think TEPCO executives were pocketing the difference. There was enormous corruption in construction. There were corners cut on safety features. With the Fukushima plant, there was backup electrical systems. They were wired on the same system. So the diesel generators and other backup systems were all wired together. They should not have been wired together. The diesel generators were not fully encased in concrete. I believe they did not put concrete over the top. So after the earthquake, then the tsunami came and the water went over the top and fried the diesel generators. There was just a bunch of stupid construction mistakes and corners cut, and a lot of people's pockets got padded, or people stole money in the construction gig. And it's that way in U.S. nuclear power plants as well. Not all of them are nearly as safe as people want you to believe. There was a in-depth story on this earlier this year. You can go search in Zero Hedge in the archives about how an earthquake in California earlier this year almost caused 2 nuclear reactors in Northern California to have big problems. So there's always investing in uranium and uranium mines, uranium exposure, always dangerous, because you could be like me, where you're up fourfold in gains on your Denison share speculation, and you're relaxing, you're thinking, oh, my God, I did a really good job on this one, it's going to go even higher, and then all of a sudden you wake up and on the news you see a Fukushima, and then all your gains are gone. So that's always a possibility, because it actually happened to me. I lost fourfold gains. There's ways you could have mitigated that risk. You could add trailing losses, stop loss, but there's possibility that the thing could have just been overwhelmed with the high frequency trading algorithms, because the high frequency trading algorithms were just becoming popular back then. So it could have went down. I think Denison went down like 40% within a couple days, and within a couple weeks it was just down. It was back down to $1. It went from, I bought the shares at $1, I want to say, and it went up to $4 per share, and then after Fukushima happened, within a week or two, it was back down to $1. So there's that risk. If you're speculating in uranium, you run that risk. So if you do have gains, this is not financial advice, just my opinion. If you do have gains, you might want to set trailing stops to protect your gains. But if there's enough people shorting and enough high frequency trading algorithms, there might not be any bidders in the market. If another accident like that occurs, there could just be lots of sellers and almost no bidders. The bidders could disappear. They could pull again. So you're running that risk. The other risk with uranium miners and speculating in uranium now is the global macro situation. And that's if things in China get worse, if problems in emerging markets get worse, if the global macro situation continues to deteriorate, you could see uranium miners or uranium projects canceled. Because these are very expensive. Billions and billions of dollars. Billions of dollars minimum. Years and years to build, lots of environmental permits, red tape, rules, regulations. I'm not sure exactly what the permitting process is in China, but here in the United States, it takes over a decade for all the permits. I believe it's over $10 million for the permits, to get all the permits needed from the Department of Energy and the other agencies, just to get approval to build a nuclear power plant. So you're looking at like a $10 or $20 million fee to build just to get the approval to build the power plant, get it through all the environmental regulations, and then you have to front out billions of dollars in capital before the power plant's built. So most investors do not want to front out that much money and wait 10 years or more to get their capital back. So there are a lot of people I know who listen to my channel who are speculating on the smaller uranium miners. The problem, I was paid to do research work a couple years ago on some of the uranium miners. One of them was Uranium Energy Corporation. They had a good business plan and were actually making money for a while with mining uranium, I think, in situ. It was a different type of mining method than the normal uranium mining method. And for a while it worked, and then the uranium price went so low that it stopped working because it wasn't economic, because no one mining uranium was making money. Not even Kazatomprom, which is another one. I think Kazatomprom went IPO recently, in the last year or so. So not even Kazatomprom was making money, and they were the lowest cost producer. But Uranium Energy Corporation, I was paid to do research on them, and I was just taking a lot of time, hours, to go through all their credit risk, bankruptcy risk, financial statements, and the stuff I was seeing in there was a lot of red flags, because they had a $19 million loan to Sprott Lending, resource lending, like Rick Rule's, one of the arms that Rick Rule runs over at Sprott, and they owed $19 million and it was due in a year or two, and Sprott had to suspend the loans. They had no revenue coming in, Uranium Energy Corporation. And the CEO, I believe, was still paying himself a lot of money at that time in salary and stock options and stuff. And Sprott had to suspend the loan, otherwise they would have went bankrupt. So a lot of these smaller uranium miners, they have really bad balance sheets. If they have any cash, they're burning through it. A lot of them don't have any revenue coming in. Because if all they're doing is mining, they're not making any money. Unless they're doing what Cameco's doing, where they're acting like a hedge fund or a middleman, where they're going into the spot market, buying uranium spot, and then selling it at a profit if they can on a long-term contract to a utility. So the risk reward to me for speculating in some of these small uranium juniors is still not worth it, unless the company is backed by a billionaire, like the Lundin family with Denison or some of the others. And even then, the billionaire family could just decide they want to stop. It's a loser. It's a money pit. They want to stop putting money in. but at least like there's someone with deep pockets who is backing it, who could put more money in. But there's just no demand right now for raising capital for uranium. Look, gold and silver prices are high, especially gold, and the gold miners can't even raise money. There's not even appetite for that, and gold miners, the gold price is high. There's not even much of an appetite for that. So I don't like the risk reward unless you're willing to take an enormous amount of risk as a speculator. There's not good risk reward for a lot of the tiny uranium miners. Because if the bear market continues, or the global macro situation gets worse, or we have another Fukushima, and there's always the possibility now of another Fukushima. There's a lot of nuclear power plants in Japan that were designed around the exact same time as Fukushima, and there could be other construction problems and construction defects there. There's construction problems and defects with older American nuclear power plants too. I spoke to a nuclear engineer about this who worked at a nuclear power plant years after Fukushima, and he was telling me that the main solution that a lot of these American nuclear power plants did was just put, hundreds of feet of concrete, blocking everything off. And yes, it blocks the radiation. There's a lot of concrete there, but a lot of other safety features. A lot of these nuclear power plants, especially ones in California, were all put around fault lines. Not only were they put next to the coast, where if an earthquake and there was like something fell off a cliff, or like there was a soil erosion, they were all put right around fault lines. Just real stupidity. Real big stupidity. Enormous stupidity. In a haste, because oil prices were high back then, there was a haste to crank out these nuclear power plants, and corners were cut in terms of location for these things, in terms of all the safety features. There's still nuclear power plants, I believe, from the 40s and 50s. Some of the first generation ones, those are still running. And they were not supposed to be running anymore in the United States. With the one in New York, Indian River? I think it's Indian River, the one not too far outside of New York City. That one was built, in the 40s or 50s? After World War II. Look at the damage from Chernobyl still. So there's a 3 Mile Island, Fukushima, and the public, not in my backyard. A lot of people in Europe, a lot of people in the United States don't want a nuclear power plant around them. There's a lot of, it's called NIMBY, not in my backyard. So in general, I'm staying away. This is not financial advice, just my opinion with my own money. I'm staying away from all uranium exposure right now. Although Cameco does look Indian Point, not Indian River. Yeah, Indian Point. My grandfather was involved in the construction long time ago. He was in plumbing and construction in New York City. But I'm personally staying away from any of these right now with the global macro situation, because if the global macro and stocks collapse, you could see even looks like good risk reward stock like Cameco, this thing could get a lot cheaper. Cameco does look like the best of the bunch though. If I was going to, again, not financial advice, if I was going to speculate, Cameco would be the one I would speculate on. Because you're getting paid a dividend, they're still cash flow positive. And the CEO, let me read some comments here from the CEO. I'll pull up this. Yeah, so Cameco's doing arbitrage right now. The spot market average price for June 30th, the first 6 months of 2019 was $24.60, and then they were flipping it and selling it to utilities at $31.50. So they were arbitraging like a hedge fund or a smart middleman. They were going into the spot market. They weren't mining uranium. They don't plan on restarting uranium anytime soon. And they were going in there and buying it in the spot market at $24.60 and flipping it on long-term contracts for $31.50 and making a profit. Pretty smart. So the CEO says there is still a long way to go before we decide to restart McArthur River We can't lose sight of the fact that while we have a true value strategy, there are still others in our industry who lack conviction, experience, or are still overproducing their committed sales volumes and using the spot market for surplus disposal. For now. So long term, the fundamentals are improving for uranium. It's still in a bear market, but the fundamentals are improving. The risk reward for Cameco does look better. Yeah, but the problem with the smaller uranium miners, Avriel, is that they have bad balance sheets and they need to raise capital. So as soon as there's a rally, they're going to drastically dilute. I don't even think the smaller uranium companies are going into the spot market and then reselling, buying it there and reselling to utilities on long-term contracts. Nuclear energy is a grand scam, says Max. It's not a grand scam. It's actually very energy dense and super efficient. The problem is the type of nuclear power that we're doing. These pressurized light water reactors are the problem. They're very expensive, which the construction industry and big nuclear likes. They're very, very expensive. So that means the construction companies make a fortune off these things. And they get to charge the taxpayer enormous cost increases. The best nuclear power technology I've seen is liquid fluoride molten salt thorium reactor, and that actually produces very little waste, and it recycles old nuclear fuel rods so then they don't have to be stored for 10,000 years or more, and then also it recycles old nuclear weapons. So the liquid fluoride molten salt thorium reactor is not an investable trend, but there's a bunch of TED Talks on it. There's the thorium remix, there's Kirk Sorensen from Flibe Energy. The U.S. I've talked about this earlier this year. The Department of Energy has blocked Lifter here in the U.S. Equity and mortgage real estate investment trust. You want to go long those things? If the U.S. can build new sports stadiums, they can build new modern power plants. Of course, the U.S. could build them. The problem is the Department of Energy and all the other industries that are corrupt that all want the status quo. Areva is the only large company in the world that actually has all the capabilities. The Russians do it too, but they're not publicly traded. Areva, I think, they're on the French stock exchange. Areva is a very large company there. They own nuclear power plants, they mine, they have a fully vertically integrated business model, and they have a very complex nuclear fuel rod recycling program. They used to be, I think, listed on American Exchange. I think they delisted. I remember them being on American Exchange years ago. Probably because of the uranium bear market, they delisted. Coal is political now. Coal is very political. Once Trump is gone from the White House, and the Democrats already have a slight majority in Congress, especially the House of Representatives, they're blocking all coal. Coal is very political now. The Chinese use coal, and there's not enormous demand globally for coal. It's not growing, it's contracting. You're not going to see any demand growth from coal. The environmentalists are going to be fighting it tooth and nail. So you may get, that's something I would not be a long-term investor in, because you're fighting all these politically, there's a lot of brainwashed people politically that just have their minds made up that they hate coal and they're going to kill it. So you think that this coal company is undervalued, and you think that you're going to get a big move in the stock price, and then elections go against you, and then the stock's down even more. Okay, I'll take a look at listener questions and comments. I'm not sure what I would talk about with equity and mortgage real estate investment trusts. If you're looking at those things, Penguin, for yield, I would avoid those. Looking on the stock market, especially real estate investment trust for yield, not the best idea. There are a few that have very high revenue per employee. There's a few. Royal Gold talked about on their slide. There was a couple real estate investment trusts that have even higher revenue per employee than Royal Gold and Sandstorm Gold and Franco-Nevada. But I mean, a lot of these real estate investment trusts own like shopping malls and other things that they're not going to be able to increase. If they increase rents, then they're going to lose the stores and restaurants. Oh, the neocons are super pissed about John Bolton. Very, very pissed. Okay, Black Swan says he knows the uranium nuclear industry. Almost all currently operating nuclear utilities have purchased uranium for the remainder of their operating licenses. Some have already paid for 20 years of fuel. Yeah, but there's 50 new nuclear power plants under construction, and those guys probably have not purchased their fuel yet. And there's only, on estimates that I've seen, 3 to 5 years of inventory overhang left. So the supply-demand fundamentals for uranium are improving, but it's the uranium market is still clearly in a bear market. Cheap shale. Albert says, who needs uranium if there's cheap shale? Shale is only cheap because of the junk bond debt and the amount of shares, the pension fund suckers. Shale was never really cheap. The costs of shale have come down, but the shale companies, it's like a hamster on a hamster wheel. They have to keep running faster and faster to maintain production. And shale is hitting a wall. Guys, I think, in my opinion, I should probably do another video on this. I've done videos on this now for the last month. There's going to be a very big oil bust unless something materially changes. In the next 6 to 12 months, there's going to be probably an enormous oil bust. The shares of Schlumberger, which is SLB, Sally, Lizzie, Brian, those shares have it looks like a yield trap to me. Those shares have collapsed. There's over a 6% dividend yield on that, and they're having to slash their prices that they charge to drill. So even the oil service companies, first of all, the shale producers, the shares, a lot of them look horrible. Look absolutely horrible to share their charts. And their financials are not good. And the oil service companies are looking bad. We could have a very, very big oil bust. I just saw a new article in the last week or so about big CapEx cuts coming. And big CapEx cuts coming for shale guys means people in Texas, Oklahoma are going to lose their jobs. I'm sad to say. And then that means the service jobs around the oil areas, like the bars, the shops, the restaurants, those guys are going to lose business and lose jobs too. Nuclear is only the future if we use lifter, liquid fluoride molten salt thorium reactor, or if someone actually cracks fusion. There was a Wall Street guy who was trained as a PhD physicist on Real Vision TV on an interview a year or two ago. It's in the archives there, you can search. And he had put a lot of his own money into fusion, and he was adamant that it will be cracked in 15 years. I don't know. I've heard that for a while. There's always that fusion is 10 years away. It's been saying that for a long time, I believe since the 50s. A lot of people have been saying that. It's 10 years away. And then, it's 10 years away. And there you are 10 years later. And then they say, it's another 10 years away. Exxon is boosting shale production. That doesn't really mean very much. Exxon is not getting... I just looked at the comments from the CEO, and the CEO of Exxon says that they're going to get double-digit returns, Albert. And no one else besides EOG Resources is getting double-digit returns. So I think Exxon is probably lying at this point. The CEO is probably lying. Exxon is claiming that they're going to get double-digit returns investing in shale now, while all the sweet spots are drilled. How are they going to get double-digit returns when all the shale experts are not getting double-digit returns? Only EOG was. EOG was getting 17% return on equity. Almost all the other shale companies were getting nothing close to that. So the Exxon Mobil CEO is lying about the returns on shale. If they're making those big capex investments into shale, they're promising growth, and it's gonna disappoint. Look, go back and listen to Art Berman and look at the interview I did with Art Berman and his articles that he puts out for free in his blog, and what Steve St. Angelo says about the shale industry. Michael says fusion is the future of energy and always will be. We'll see. I actually think I've been watching videos on this. There's been a lot of gains in graphene. So a lot of positives coming out of the lab. We should actually have some commercial products in graphene, some good ones in about 5 years, maybe 10 years at most. So there's been some big gains in graphene. Now that doesn't mean I would not use speculating graphene miners, but I would monitor it. I don't think it's investable yet. Just like how liquid fluoride molten salt thorium reactor is not investable, graphene to me is not investable yet. But there are a lot of cool stuff coming from the labs, and the cost to manufacture the big sheets of graphene, those things, the costs have come down a lot. So we're starting to get to that Moore's Law innovation period where the costs are going to just rapidly drop and the quality of the sheets for graphene are going to keep improving. I'm monitoring that. It's not investable. So I outlined... No, I did not watch Chernobyl yet. I've heard it's good, though. So I've outlined a lot of the risk and reward parts for uranium. There is opportunity for speculation there. I don't think it's very safe, though, especially for the smaller uranium companies. It's still clearly in a bear market. The uranium companies do not have, the smaller ones especially, do not have good balance sheets, so they're going to have to dilute. You have to look at the burn rate. How much cash are they burning? How much cash is on their balance sheet? Not a lot of people watching. Uranium is not a hot topic. Okay, well, I was trying to be contrarian, and a couple people did ask me for a uranium update, so I gave this one. So I would monitor, just me personally, I'm monitoring Cameco. I'm thinking about it, but I haven't bought any shares yet. I'll let you guys know if I do. But once things do turn, there is a possibility for a double in share price, maybe even a triple, a 3-bagger or a 4-bagger. Because this could, for a lot of the company's history, Cameco was making a good earnings per share, solid dividend, and the stock has routinely been in the past, before the bear market and after Fukushima, been above $30 a share. This has been probably the worst bear market, though, of any commodity I've seen, this uranium bear market, because of the stigma of not in my backyard with nuclear power plants, and then also still fallout problems with Fukushima. Okay, there's been a lot of exploration success, I think, in the Athabasca Basin for high-grade uranium. I think it's at Athabasca Basin. So there's like Energy Fuels, Fission Energy, that have found very high-grade uranium deposits, but the market has not treated those. In the past, they temporarily treated them well, but they haven't sustained. So there's very high-grade projects. But I think the bear market's going to continue, unfortunately. I think Cameco will survive, but you have to monitor their balance sheet, because right now, in my opinion, I think Cameco will survive. They have the best chance to survive, at least. Their debt-to-equity ratio is not insane. Yeah, they have almost $5 billion Canadian dollars in equity and total non-current liabilities. So they have more equity than debt, and they have way more equity than long-term debt. So they're not like one of those companies like Campbell Soup where they have 3 times as much debt or liabilities as equity. So I think as of right now, looking for companies if they can survive risk reward with debt to equity ratios, debt to cash flow. Cameco doesn't have free cash flow yet, but they're cash flow positive. Cameco has a good chance to survive the bear market. I'm aware graphene is not mined. But there's tons of pumpers in Vancouver that are telling people that the graphite miners are a great play on this. Trust me, I've gotten tons of spam emails over the years. They're in my spam box. Hundreds and hundreds of them. The carbon graphite is actually very common. Then you have to turn it into a single sheet of graphene. It's a very difficult process. It used to be extremely expensive. The costs on it are coming down. Okay, guys, bye for now.